We've had an amazing 3-year run in the S&P 500. In 2023, we did 24%. Last year, we did 23%. And this year, we're doing 16.5% on the year. And anytime we have 3 consecutive years of positive returns, especially double digits return, the fourth year tends to be a really negative year. And you could notice the trend of 3 positive years, negative year, 3 positive year, negative year. Maybe next year is different. Maybe you go straight to the moon to 2030 and we all become millionaires and billionaires. But the odds of this continuing is extremely, extremely low, especially taking into consideration that next year is a midterm election year. And the midterm years are notorious for having massive drawdowns from peak to trough, with the average drawdown in a typical midterm year being 17.5%. 17.5% on the S&P. It's 25% on the NASDAQ. It's 50, 70, 80% on the Cassie Wood unprofitable ARK Innovation stocks. This is really, really bad. In 2022, it was 25%. 2018, 19, and 2014, it was 7% of peak to trough in terms of a decline. And if you look at where we are on valuations, we're trading at 22.5 times forward earnings, as high as we were in 2021 before the 2022 stock market crash, and very close to where we were during the dot-com peak. So if the S&P goes down 15 or 20% from here and it goes to 20 times earnings, we could still argue that at 20 times the S&P 500 is not really a bargain at all. But I believe, and you guys know that valuations are terrible timing indicators, and we can remain overvalued forever, and we just keep on going up and we keep remaining overvalued, which is why we need a catalyst. We need something bad to happen for the market to even sell off. And I don't just have one catalyst, I have 2 catalysts that I'm going to talk about in today's video. And I really hope you enjoy it as always. I'm not trying to time the market when I talk about those things, but I believe that we should know where we are in the market cycle, and we should know if we should be a little bit more fearful going into 2026, or if we should be extremely, extremely greedy. And the biggest catalyst by far, in my opinion, is OpenAI. OpenAI is worth $500 billion. OpenAI doesn't really generate a profit. They do equity raises and they do all kind of crazy deals for them to finance themselves. They finance themselves through equity deals. Now, OpenAI is not expected to be profitable before the next 5 years, and maybe it will never be profitable. This is a recent article or a model from HSBC, which they built it to figure out if OpenAI can actually pay for all the compute they have committed to. The answer is no, they can't. OpenAI has committed to $250 billion in contracts from Microsoft Azure and $38 billion from Amazon. And they built this model. Even if they generate revenues, even if they do some equity fundings, they still can't pay their obligations. If OpenAI can't pay, Oracle is in massive, massive trouble. And Oracle could be a black swan event on its own or a catalyst of its own, as the credit default swaps or the hedge against Oracle defaulting on their debt is reaching highs we haven't seen since the 2022 stock market crash, as the company has a lot of debt. And I think they're going really aggressive on their cloud strategy, and there's no guarantee that it could potentially pay off. But if OpenAI can't pay, Oracle is in trouble. Microsoft is in trouble, as a lot of the Azure growth is coming from OpenAI. AMD is also in trouble due to their deal with OpenAI. And NVIDIA is in trouble, not just from OpenAI, but is facing more and more competition from Google, AVGO, Marvell, and potentially China innovating even more, as we did have to cut off some of the semiconductor shipments to China, and that's encouraging them to make their own chips and their own technologies in general. And you combine all those things, you have a really bad setup that could happen in 2026. Now, some of you might say, what are you even talking about, man? OpenAI can put up ads on their model and they can generate revenues. They can do another equity raise and generate revenues. They can go public and raise equity and do all these things. And yes, you're right 100%. The reason why OpenAI has been valued at $500 billion, and the reason why they can can raise money like they do is because they are the leader in AI. And until recently, they were the undisputed leader. No one can even rival OpenAI and ChatGPT, which is their main model, except Google. Now we have Gemini. Gemini is rapidly taking share from OpenAI, and I think this risk is not being appreciated enough. Gemini, guys, is not funding itself. Google is funding Gemini. So if OpenAI wants to put up ads because they're desperate to generate revenues to fund their operations, Gemini is going to be free. Okay, Google can afford it. If OpenAI want to price their best model at a premium, Gemini can give it to you for free. So Gemini is in a position to bleed off to death OpenAI pretty much if they wanted to. And they're rapidly taking market share. If OpenAI doesn't innovate, doesn't do something really, really special, Gemini and potentially Meta could enter the competition, and other chatbots, they could enter the competition. Now, if that's happening, OpenAI is not going to deserve the premium it has always deserved, not in an equity raise and not even an IPO. And they're not in a position to generate revenues because Gemini and Perplexity and others can give you the same kind of product, even better, for pretty much free. And I've heard a lot of people that have used Gemini and haven't gone back to OpenAI ever again. And this is a major risk for OpenAI, but not just for OpenAI, for all the companies in the ecosystem of OpenAI. Because if OpenAI does not succeed, a lot of companies will be in trouble. And a lot of companies' success are built on OpenAI succeeding, and OpenAI is being rivaled for the first time ever in a major way by Gemini and other companies like Meta with 3.5 billion people of reach every single day can potentially enter the competition and make it even harder for OpenAI to ever be profitable or to monetize their business in general. But there's another, you could say, black swan event or another catalyst that is not talked about enough, and this is the yen carry trade. If you're not familiar with the carry trade, I'm going to explain it to you. Over the last 10 or 15 years, the interest rates in Japan have been going down a lot. And because they've been going down a lot, the yen has been depreciating a lot, and the interest rates in Japan, they went to 0.5%, 0.1%, 0.2%, because the government in Japan, their debt to GDP is very, very high. They have a lot of debt. So they were artificially suppressing interest rates through yield curve control. Now, because of that, many US investors and investors in general, they borrow money in yen. So they're taking a loan, you could say, on yen, or they borrow Japanese yen in general at 0.1%, 0.5%, 1%. They use the money to buy US stocks. Now, if the yen is depreciating, they are short the yen and long the dollar. So they are benefiting from the yen going down and they're benefiting from stocks going up. And that has done really well over the last 5-10 years. But this is breaking in real time with the 10-year in Japan reaching 1.9%, a level we haven't seen since 2005 to 2006. So now the yen is starting to appreciate. So the people that are short the yen to buy US stocks will eventually have to sell US stocks for them to cover their yen short because it's no longer working. And that could pull off a lot of liquidity from the market. It did happen in 2024 for a few weeks, and it has caused a major sell-off in August, September, if you remember. And it could potentially happen again in 2026. But there's something else that I'm monitoring, and this is the indicator that has allowed me to sell all my growth stocks in 2021, short ARK Innovation, and make 27% in 2022. And this is the margin debt year-over-year percentage change. Anytime the margin debt indicator goes above 60% in a single year, we have a major crash happening, let's say 6 to 8 months after that. It has only happened 3 times in history. In 2021, around August, if I remember, it happened in 2007 before the 2008 bust, and it happened before the 1999 stock market crash. This is 100% accuracy, guys. We're sitting at 45%. It's about a month and a half lagging, so we're headed to 60%. And if it does get to 60%, then this is the mother of all indicators warning us that something bad could potentially happen. Now, there's one way that I could be wrong on all of this, because if you really look at it, it seems obvious, especially if you study market cycles. Most of the major themes like the internet, and now we have AI, we tend to have a boom, then we have a bust, And then after the bust, you tend to have the major changes where the internet changed people's lives. But you have to have a bust after the boom. It's not a boom and it just goes on forever. And OpenAI, or I should say AI in general, haven't had their bust cycle. We only had a crash because of the tariff, but it had nothing to do with faith in AI or maybe the thesis on AI being tested or being doubted in general. And that should naturally come within the cycle. But one thing I could be wrong, or one way I could be wrong, is mainly with having lower interest rates or a looser monetary policy in general, with Trump urging the Fed to cut rates to 1%, and a new Fed chair, which is Kevin Hassett, that could potentially be the Fed chair. Some bond investors are not too happy with him, and they are warning the Treasury that Kevin Hassett could cut interest rates too aggressively to please Donald Trump. If we have lower interest rates, we have a looser monetary policy, it's very hard to be bearish. It's very hard to say that Bitcoin will go down under a scenario where interest rates are coming down and the Fed is printing money. Or it's hard to say that AI stocks or any stock would be going down under such a potentially aggressive monetary easing. That would be really, really bullish. But there's one piece of information that investors are missing, and this is the 10-year yield. Despite the effort from the president, from even Jerome Powell was starting to ease a little bit this year, from the Treasury Secretary himself, they couldn't lower the 10-year because the 10-year isn't really controlled by the Fed. The Fed controls the shorter term, and sometimes they do buy some bonds in the open market, but the 10-year yield for them is a benchmark for the market and is very hard to control. So if the bond investors believe that the Fed chairman is cutting rates too early or too quickly, we could have a setup where interest rates are coming down, but the 10-year bond yield is going up because bond investors believe that we're going to have massive inflation because of those policies in 2027 or 2028. And in this case, you're not going to get the face-ripping rally that everyone is hoping for, and everyone believes that if interest rates come down, stocks go up. Not always. The 10-year could go up. And if the 10-year is going up, it's going to be hard for the market to just keep ripping higher and make crazy new highs. I'm not saying it's impossible, but this is a very likely outcome. Now, in terms of what I'm doing, because I don't just talk about those things to get views and talk about them on YouTube, I actually do something about it. And there's two things I'm willing to do. The first thing I'm looking to do is I'm not entering 2026 without having at least a 10% cash position. And most investors don't like to have a cash position because they are worried from opportunity cost, because we've had the FOMO market from 2023, where if you had a 1% cash position, you were worried of missing on the upside or missing the bottom or missing the next stock that's going to go up 10, 20, 30x. But I believe that we had an amazing 3-year run, and based on everything that I'm telling you and everything I'm saying, I believe it would be something responsible to hold 10% cash. It would not be timing the market. A lot of your companies you buy, the stocks you buy, you would prefer if they have a good balance sheet, right? You would prefer if they have a cash position, because if their stock goes down, they can buy back the stock at a low price and take advantage of it and create value for you as a shareholder. So why would you believe that if you're doing it, does that mean you're timing the market and you have to be leveraged on margin to generate good returns with the kind of setups that I'm talking about? So for me, I don't really care. I'm going to enter 2026 with a 10% cash position, and I think this is the best thing for most people to do. Now, the second thing that I'm doing is I want to buy put spreads, and this is something I have done before, and I'm going to do it again. With put spreads, you're mainly buying a put option on the S&P 500, and you're selling a put against it. This way, you know what is going to be your maximum upside, your maximum return, before you even enter the option. And it's very cost effective. So let's say I put in 0.5% of my portfolio in this option, and the S&P goes down 20%. This option should about 9 to 10x. If it does 10x, the 0.5% will turn into 5% of my portfolio. This way, if I was going to be down 10% on the year, I would be down 5% because this 0.5% hedge has shaved off 5% of my losses, but it's also giving me a 5% cash position at the bottom of the market when everyone has no cash for me to take profits on and go buy the growth stocks like Robinhood and other stocks that are going down and that nobody wants. But if it doesn't work out, then I lose 0.5% of my portfolio as an insurance policy, which is something that I can sleep well at night doing. And if you're looking for help in terms of how to learn those things and how to do them, I share everything in real time in my own group. And this is the link if you're interested. But that was just my opinion on the market and the S&P 500 in general. I'm not trying to time it, but I have a thesis and I thought I would share it with you. And I hope you benefited. I hope you learned something. If you agree, disagree with me, let me know in the comments. But thank you for watching again, and I'll talk to you in another video.